Well, good morning, everyone. It is Friday. It is July the 26th, and it's been raining a lot, but I hope you're doing well. The markets have been in a bit of transition, a bit of volatility. So I know I gave an update last week, so I thought I would do another, hopefully quicker one this week. We have continued to see the volatility in the markets. Wednesday was a huge day, and there's a rotation going on. And what that means is money is moving from the technology large cap names where all of the gain in the S&P 500 has been, or the index, and it's moving more to the areas that have not participated, the consumer cyclicals, the industrials, the what we would consider the value type companies. Now, what that may appear to be sort of a negative, but that's actually a positive. That means that the market is broadening out, that there are more stocks participating, and that's actually a good number. Now, this market for the past, how long has it been? 2000 and beginning of 2022, something like that, when you heard the term that inflation is going to be transitory. And I made a big deal about that on these videos, that the Fed kept calling it transitory, and then it became a problem. And so the Fed now is saying, well, we're trying to get to our 2% target, and that's 2% on top of 15%, by the way. So a good way of thinking about it is that if you put on 100 pounds over the course of the year, you still weigh 100 pounds more than what you did the year before. And if you only add 2 pounds, you're now 102 pounds. But what people say is, oh, it just grew by 2%. That's on top of what's already been added. So it doesn't feel like that inflation is going back to where it was. But the Fed has done what I think maybe is a good job in not leading us into a recession by raising the rates. But now the word that we're hearing is that the Fed can start cutting rates, maybe once, maybe twice. We heard this back in October of 2023, and that's that we were going to see 6 rate cuts in 24, and that's what made the market explode at that point. We haven't seen any of them because the Fed has come out and said the data, but they help control the markets just by talking about interest rate cuts. So the Fed's doing the same thing now. Some of the Fed governors have said we've got to cut rates at least once right now. So the market is reacting very favorably to that. The personal consumption numbers came out this morning, and the number was not quite as bad as what they were expecting. In other words, they are able to maybe cut rates in the future because the spending patterns of people in the economy, sorry about that, are performing differently than what they had expected. So I know that's a little bit wordy, but I did want to give you this from this morning. This is from Larry Adams, who does an investment strategy with Raymond James every morning. He's an analyst with Raymond James, chief market strategist for Raymond James. But he had a couple of really good points this morning that I wanted to share with you. He says, and he's talking about the U.S. real GDP is strong, and he's comparing it to the Olympics. He said investors, just like Olympic athletes, should look forward rather than backwards. And while yesterday's GDP, the gross domestic product, report beat expectations, 2.8% versus what was expected of 2%. It measured economic activity between April and June, which includes data as far back as Easter Monday. And he points out that's 116 days ago. However, listen to this, with Paris hotel prices down 41% from their inflated peak, down 41% from 11 months ago, and 300,000 unsold Olympic tickets, consumer spending globally appears to be slowing and becoming more discerning. He goes on to say the U.S. was the 2020 Summer Olympics standout in Tokyo, earning 113 medals, the most of any country. Similarly, listen to this now, I think this is good stuff. The U.S. has been the standout economically since the last Summer Olympics which were postponed to 2021, as the U.S. GDP has grown 22% over the last 3 years, the most of any G7 country. It has far surpassed both Europe and the host country France, as U.S. GDP growth has doubled the pace of each. Stronger growth is one reason why U.S. risk assets, in other words, stocks, mutual funds, real estate, have outperformed. So he says, go to Team USA. Not only does the U.S. dominate the global economy, but the U.S. equity market and companies also dominate. In fact, the U.S. market cap as a percent of the world market cap, in other words, the total value of all of our markets compared to the total value of the rest of the world markets, has gone from 28% in 2010 to 48% today, a trend that is likely to continue. The U.S. also has the strongest companies, as 18 of the top 20 companies in the all-country world index are based in the U.S. There are no European companies in the top 10, and the top French company is 50th. So let me say that line again. The U.S. market cap as a percent of the world market cap has gone from 28% to 48%. So that's a really cool stat there that I just didn't realize. He said U.S. equity returns in 2024 continue to excel in the global landscape, and despite the recent drawdown of 5% in the S&P 500, the S&P 500 remains up 14% year to date. Now, we're having a good day today, so it's just up 14% compared to, excuse me, the Dow Jones is up 7.5% year to date, and the NASDAQ is up just over 15% year to date. So these are all good numbers. And he said the recent, past that, he says not only does earning a spot in the Olympics podium earn athletes a level of prestige, but it also provides significantly more value, because he's talking about gold and silver. So gold and silver has also been on the uptrend, even though it's pulled back from where its peaks were. It's actually, but it's still up for the year. So even the commodities are doing well also. And so I think that we get in our political environment that we're in, our news environment, it's hard to see that, hey, the markets that we are, the companies that are in the markets that we own and that we use, they're actually some of the best in the world. So we are seeing some rotation in stocks. We are seeing a little bit of a pullback here recently in the indexes. To me, I think it's just giving some buying opportunity. That I just don't think that there is a crash on the horizon. I don't have a crystal ball. Even if I did, I'd have to spray Windex on it to clear it up. But it just, based on all of the charts, the technical analysis, the fundamental analysis, the fact that interest rates are poised to perhaps come down sometime soon, I think the market, even though we may have a pullback, I think we're in a pretty strong bull market. Now, you might be thinking about the election, and typically when there is no incumbent in the election, that the markets react a little unfavorably to that, because they don't know a lot about either candidate. Now, the market knows about Trump, and so there is some inflection in the market that the market is doing well, because they know what a Trump presidency looks like. They don't know what a Harris presidency looks like, if in fact she ends up being the nominee, which it appears that she is going to be. So there is some uncertainty along those lines. So with that said, thank you so much for listening. This ended up being a whole lot longer than what I planned, but I hope it's informative for you. And as always, if you've got any questions or concerns, don't hesitate to call. And as always, I really appreciate you letting us work for you. Have a great weekend.